Welcome to this comprehensive look at the foundation of financial reporting. To truly understand a business's performance, we must look beyond simple cash flow. Cash accounting is straightforward. You record revenue when you receive a check and record an expense when you pay a bill. While simple, it often distorts the timing of economic activity. Accrual accounting, however, focuses on when economic events actually occur. Revenues are recognized when earned, and expenses are recognized when they are incurred or when their benefits are used, regardless of when the cash moves. Imagine a consulting firm that performs a $5,000 project in December but doesn't get paid until February. Under cash accounting, December looks like a failure and February looks like a massive success. Under accrual accounting, that $5,000 is correctly attributed to December, reflecting the actual work done and providing a much more accurate picture of the company's monthly health. Accrual accounting is governed by two vital pillars: conservatism and realization. The conservatism concept dictates that we only record an increase in revenue when there is reasonable assurance that the payment will actually be received. We don't count chickens before they hatch. The realization concept states that revenue isn't recorded until the product or service is actually delivered. Let's walk through a 3-day scenario. On Monday, a customer promises to buy a custom sofa. We realize nothing yet. On Tuesday, we deliver that sofa. This is the realization event. The revenue is recorded now. Even if the customer pays on Wednesday, the revenue belongs to Tuesday's books. But what if they pay the full amount on Monday before delivery? That cash isn't revenue yet. It's recorded as deferred revenue. Because the company still owes the customer a product, deferred revenue is classified as a liability on the balance sheet, only moving to the income statement once the sofa is delivered. Not every dollar spent is an immediate expense. Accountants distinguish between expenditures, costs that decrease assets or increase liabilities, and expenses. An expenditure is unexpired as long as its benefits haven't been realized. Once the benefits are used up, it becomes an expired expenditure or an expense. This leads to the matching principle, where we record expenses in the same period as the related revenue. A perfect example is bad debt. If we sell $100,000 of goods on credit, we know from experience some customers won't pay. Instead of waiting for them to default months later, we preemptively estimate this loss. We create a contra-asset account called allowance for doubtful accounts, which is subtracted from our accounts receivable. We simultaneously record a bad debt expense. This ensures the income statement reflects the true cost of those credit sales in the same period the sales occurred, and the balance sheet shows the net amount we realistically expect to collect. When a company sells a product, it must move the cost of that item from inventory on the balance sheet to cost of goods sold, or COGS, on the income statement. But which cost do you use if prices have changed? There are 3 main methods. Specific identification tracks every individual item, useful for cars or jewelry, but impossible for cereal. For bulk goods, we use cost flow assumptions. First in, first out, or FIFO, assumes the oldest items are sold first. In a period of rising prices, FIFO uses older, cheaper costs for COGS, which results in higher reported profits and a higher ending inventory value. On the other hand, last in, first out, or LIFO, assumes the newest, most expensive items are sold first. This leads to a higher COGS and lower taxable income, providing a tax advantage during inflation. We also track conversion costs, the direct labor and overhead required to turn raw materials into finished goods. Overhead is distributed using an overhead rate based on metrics like labor hours to ensure every unit of inventory carries its fair share of indirect costs. Fixed assets like a delivery truck or a factory machine are tangible, non-current assets that provide value over a service life. We use depreciation to expense these assets over time. The most common method is straight line. Suppose a machine costs $50,000, has a salvage value of $10,000, and a 4-year service life. We subtract the salvage value from the cost to get a $40,000 depreciable base, then divide by 4 years, resulting in a steady $10,000 expense every year. However, if the asset's wear depends on how much it's used rather than just time, we use units of production. We take that same $40,000 depreciable base and divide it by the total expected output, say 100,000 units. This gives us a depreciation rate of 40 cents per unit. If the machine produces 15,000 units this year, our depreciation expense is $6,000. This method perfectly matches the expense to the actual physical consumption of the asset. Some assets lose value much faster at the beginning of their lives. Think of a new car driving off the lot. To reflect this, accountants use accelerated depreciation, which assigns more expense in the early years and less toward the end. Every time we record depreciation, we add it to a contra asset account called accumulated depreciation. This account keeps a running total of all depreciation taken to date. By subtracting accumulated depreciation from the asset's original cost, we arrive at the book value. Let's look at a 5-year asset with a $40,000 cost. In year 1, accelerated depreciation might be $12,000, leaving a book value of $28,000. By year 3, the accumulated depreciation has reached $30,000, so the book value has dropped to $10,000. This decreasing book value represents the remaining unexpired cost of the asset on the company's balance sheet. The logic of depreciation applies to other assets too, just with different names. For wasting assets, like oil wells or gold mines, we use depletion. We calculate a depletion rate by dividing the total value of the resource, the depletion base, by the estimated total units available. As we extract resources, we record the depletion. For intangible assets, such as patents, copyrights, or trademarks, we use amortization. This follows the matching concept, spreading the cost of the intangible over the time it provides value. Finally, what happens when we're done with an asset? When we sell or dispose of it, we compare the sale price to the current book value. If we sell it for more than its book value, we record a gain on asset disposal in equity. If we sell it for less, we record a loss. This final step removes the asset's cost and its accumulated depreciation from the books entirely, closing the loop on the asset's life cycle. We've covered a lot of ground, from the timing of revenue realization to the systematic expensing of long-term assets. Whether it's estimating bad debt to satisfy the matching principle, choosing between FIFO and LIFO to manage inventory costs, or calculating the depletion of a natural resource, these accounting practices serve one purpose: transparency. By moving away from simple cash tracking and toward accrual-based recognition, businesses can provide investors and managers with a consistent, reliable narrative of how value is created, used, and maintained over time. Mastering these fundamentals allows you to look past the bank statement and understand the true economic engine of any organization. Thank you for joining this deep dive into revenues, expenses, and assets.